This conference will now be recorded.
Okay, so good afternoon, everyone. So now let us start the session. Okay, so let them join later. Okay, so in the previous class, I was discussing with you about the income statement exercises. So I think I have shared you the file, right? So you are doing that. You have done those problems. Actually, two problems I have explained for you. So you have any doubts in those?
No, ma'am.
No. Okay. So then let us continue those exercises only. Okay. So this is our format. So that's nothing but first we have to put the revenue or the sales. So then minus cost of goods sold. So cost of goods sold is nothing but opening stock plus purchases minus closing stock. You will be getting the COGS, that is cost of goods sold. So then you will be getting the, if you just less it, so then you will be getting the gross profit. So then all the expenses, like these are all called as the operating expenses. So that's nothing but research and development expenses, repairs and maintenance, salaries, lease payments, and advertising expenses. So total operating expenses you'll be getting here as 4,17,000. So then after that, so if you just less this, so gross profit minus total operating expenses, you'll be getting EBITDA. So that means EBITDA, earnings before interest, tax, depreciation and amortization. So then what is this depreciation? Depreciation is 78,000 they have mentioned here. So now if you just deduct that particular EBITDA minus depreciation, you'll be getting the answer as EBIT, okay, as 2,82,000. So then again here you are having interest expenses, that is 64,000. So that interest also you have to put here as 64,000. So then you'll be getting the answer as 2,18,000 as EBT. So that means earnings before tax. So then again here you have to put the tax here. So that means 51,000 is the tax. So this is called as the, if you just minus it, less it, you'll be getting the answer as profit after tax here. Okay, so this is how we have to calculate the earnings, earnings after tax or profit after tax. Okay, so EAT or PAT we can just calculate. Yes. So then after that we will just go to the third one. Okay. So this one also I have explained, I think, no. That means in yearly. So yearly 8% it has been incremented. Okay. So increment has been done. So how to calculate this? Is equal to, okay, is equal to 900. Okay, so first you have to put okay, 900 only you select. So and then into 8%. Okay, 8% you put. So the brackets you just open and close the brackets. So then this one, okay, so plus, okay, so plus 900. So this is one method of doing this. So once if you just do it and if you just drag it, automatically it will be uh, you know displayed. Okay, so that is about the thing. And the same thing if you just copy and paste it, so copy and paste it. So the same formula it will be pasted here, but it has been pasted according to the 8%. But if you just delete this and if you just put 12%, so then it will be displayed here as 392 rupees, like that. Understood, no? So this is one method, and the other method is nothing but, so is equal to, okay, okay, 900 into, Okay, 900 into 1 plus, okay, 1 plus 8%. Okay, 1 plus 8%. So and then press enter. See now, this also, here also will be getting the answer here as 972. Okay, so again if you just click and drag over here, automatically you will be getting the answer here as 8%. Every year it has been increased here. Okay, so or else so the same thing, you just copy and paste it here. Okay, so again the same thing, so you just edit this as 12%, so and then press enter. Okay, so now this is about 392, so you just click and drag it over here, automatically you will be getting the answers here. So do it guys. So there are two ways, two methods of doing this, so you just try it out. And if you just calculate the gross profit, how to calculate the gross profit? So revenue, so that means the sales minus, okay, so the COGS. Okay, so sales minus COGS, you will be getting the answer as gross profit. So here you will be getting the 550 as the answer. So now you just drag it over here, automatically you will be getting the answers here. Okay, so now here you will be getting the total operating expenses. So how to calculate this? So in the same way, you just drag it over here, automatically so the things will be set here, automatically it will be calculated like that. Then what about this EBITDA? So EBITDA is nothing but like a gross profit. Okay, so minus total operating expenses, so is equal to gross profit minus total operating expenses. You just select that and then press enter. So now you will be getting the answer here as EBITDA. So you just drag it over here, automatically you will be getting the answers here. Try it out guys. So then after that, so we will just apply this EBIT. So automatically they have given here the first one answer as EBIT as 384. So how to get this 384? So that means here EBITDA minus depreciation. Okay, EBITDA minus depreciation, you will be getting the answer here as EBIT. So again interest charges, it has been applied here, so again you have to deduct this amount interest charges from the EBITDA. Okay, EBIT, sorry. So then you will be getting the answer here as PBT, so that means profit before tax. Okay, profit before tax. So then in the same way, current taxation, current tax at 35%. So here so there here minus it is there actually, those 3 years we didn't get any profit, so we incurred loss here. So that's why you can just put here a zero only, because minus only you got, no.
Ma'am, your voice is not hearing, ma'am. Ma'am,
Okay, yeah. So this is yeah. I'm audible now. Yes. Okay. Yeah. So am I audible now? So these are about the profit of after taxes. So that means, so here since we have not got the profit only, so we cannot pay taxes here. Okay, so that is about the thing. Okay, in the middle years, that means second, third, and the fourth years, so we will not be able to pay the taxes. Understood about this problem? Any doubts?
once again explain, ma'am.
Once again, you want me to explain? Yes.
Yes, ma'am.
Yeah. So now here, now here we are having the data. That means we are having the problem here. Year 1, year 2, year 3, year 4, and year 5. 5 years are there. So in this, so we are having the sales. So what is the format here? So revenue or the sales we have to put here. Okay, so the sales. So and then in bracket what they have given, increment by 8% yearly. So that means the sales is increasing 8% yearly, okay, on yearly basis. So that's why we have to follow the method as is equal to this year 1 sales into, okay, year 1 sales into, okay, into. So now open the bracket, okay, open the bracket, 1 plus 1 plus 8%, okay, 1 plus 8%, and then close bracket. Close bracket and then press enter. See now here 972. Understood this method?
Yes, ma'am.
Yes. So now you have to drag this. So you just drag it over here. Automatically you will be getting 8% per annum. It will be increased. The sales. Okay. So then after that, okay, after that, what you have to do is, so you have to copy this. Okay. You have to copy this. And this is about the COGS. So cost of goods sold. You just paste this. So you just copy and paste this. Paste this. So the same formula will be copied with 8% per annum. So at that time, what is the COGS they have given you here? So COGS they have given you here is increment by 12%. Okay, increment by 12%. So that means 1 plus 12% here. So and then press enter. See now we'll be getting the answer here as 392. Okay, 392. So now after this again you have to drag it over here. So you just drag it over here, automatically it will be displayed. Now the gross profit we have to calculate here. So how to calculate this gross profit? So that means the sales minus COGS. Okay, sales minus COGS, you will be getting the gross profit as the answer, is equal to, okay, sales minus COGS. Okay, so now press enter. See now we will be getting the answer, that means the gross profit as 550. So now you just drag it over here, automatically you will be getting the answers. So that means the gross profit for the respective years, it will be added and it will be shown here. Till here you understood?
Yes, ma'am.
Yes. So after this, so automatically they have given you the OPEX. So that means the total operating expenses as employee cost, power cost, packaging cost, advertisement cost, commission, maintenance cost, insurance premium, administration, and miscellaneous expenses. So automatically they have given yearly. So like what are all the expenses they have incurred. So at that time, so you just select this only, automatically it is there, and then you just drag it over here. So then total operating expenses for the respective years, it will be displayed here. So is equal to some open bracket. So from K6 to K13, it will be displayed here like that. So then after that, we'll be getting the EBITDA. So we have to calculate EBITDA. So EBITDA means the gross profit minus total operating expenses. You'll be getting the EBITDA. Okay. So now is equal to gross profit. Okay. So gross profit minus total operating expenses you have to select here. So and then press enter. See, now you'll be getting the answer here as 41. Okay, so in the same way, you just place the cursor in the corner and then you just drag it over here. Okay, so automatically you will be getting the answers here like that. And you will be getting the EBITDA. So again, if you just less the depreciation, you will be getting EBIT here. So EBIT means the depreciation automatically they have given. So you just drag it over here, automatically you will be getting the EBIT. So then interest also you have to less from this. Interest also they have given you automatically. So just you auto so like you, it will be displayed. Okay, so then actually the PBT, that means the profit before tax. So we have not incurred, I mean, we have incurred loss in these 3 years. So that means year 2, year 3, year 4, we have incurred the loss here. So that's why, so there is no need of paying tax only actually, because we have incurred loss only, right? So at that time, so but even though we have to calculate the tax here, so you just put it and you just drag it over here, but here we have got the 7 rupees as the profit before tax. So that means the 35% on the profit before tax. So then after this profit after tax, so you have to minus this 315 minus 110. Okay, profit before tax minus the tax amount will be 110 rupees. So you have to less this, and then finally we'll be getting the answer here as so the profit after taxes 205 minus 30 minus 30 minus 4, then 12. So you just try out this one. So I have shared you this file now. Are you doing? So while doing any doubts you got, so just call me, or you just ask me. I'll just clarify your doubt. Doing, guys? Any doubts? So shall we move to the next one? So that means the fourth one, income statement 4. Shall we do this?
Yes, ma'am.
Ah. So what is this? So you just prepare an income statement of Pankaj Traders. So that means Pankaj Traders purchased 100 tables for rupees 500. So what is this actually? So that is nothing but the sales, sorry, purchases, right? So sold them all for rupees 750, right? So so here what we have to put, so that means, so we have to put the first as sales here, right? What is the sales? So how many number of tables we have purchased? 100 into, at what price we have sold?
100, ma'am.
100, right? So no, no, selling price in the sense 750 rupees you have to put. Okay, 100 is number of tables. Okay, number of tables we have sold. Okay. Okay, so now press enter. See, now we'll be getting the answer here, 75,000. Okay, so now uh, here we are having the COGS. So that means cost of goods sold. So that means, so here purchased 100 tables. Okay, so at rupees 500. So that means is equal to 500 into 100. Okay, so cost of goods sold. So then you will be getting the gross profit. Okay, gross profit is, how to calculate this, is equal to 75,000 minus 50,000. Okay, 25,000 is the gross profit. So then total OPEX, okay, total operating expenses, you'll be getting the rent as rent, staff salary, other marketing expenses. So you'll be getting here as 2000. Okay, then you'll be getting the answer as EBITDA if you just deduct the gross profit minus operating expenses. Okay, so then again you have to put the depreciation, okay, and amortization. So depreciation on the machine will be rupees 2000 and amortization will be 1000. So totally how much? 3000. So now you have to put EBIT. Okay, so now is equal to 23,000 minus this 3000. So and then press enter. See, now you'll be getting the answer as 20,000, and it is regarded as EBIT, earnings before interest and tax. So now again minus interest charges, okay, interest expenses, okay. So took a loan of rupees 10,000 at a interest rate of 10%. So that means is equal to 10,000 into 10%. Okay. So now press enter. So 1000 rupees is the interest. Okay. So then again, so now you will be getting EBT. Okay, EBT. So now is equal to 20,000 minus 1000. So you'll be getting the answer as 19,000 after deducting interest charges. Okay, so now here taxes you have to deduct. So what is the tax here they have given? So the tax rate is 25%. So 25% is nothing but, so 25% you have to calculate on EBT is equal to 19,000 into 25%. Again press enter. 4,750. So now after paying this this we will be getting EAT or PAT. So that means profit after tax. So this one 19,000 minus 4,750, you will be getting the answer as 14,250. So that means, so this is your profit after tax. Understood? You just try it out, this one, fourth one. Or else you want me to explain again, I'll explain you. Or you want you to do, you just do. I'll just give you 2 minutes time. Done. Any doubts in this? So, shall we move on to the next one? That means the fifth type of income statement, or will you do it by this one by itself, by yourself, or else you want me to explain once and move to the next? 1 minute. So this one, will you do it by yourselves? So the income statement number 5. So that means the sales. Okay, so once I will just explain you, and then I will go for the next topic, that is a balance sheet. So sales volume. Okay, so sales volume, that means so here 1 lakh is the base. So that means is equal to year 1 is 1 lakh. Okay, 1 lakh into how much is the sales price per unit? 125. So you just put here as 125 and then press enter. See now. So 12, so how much? 1 crore 25 lakh. Okay. So now year 2. Year 2. So each year revenue increases by 15%. So that means is equal to year 1 value into 1 plus 15%. 1 plus 15% and then close bracket, enter. See now. So then in the same way you just drag it over here, automatically you will be getting the answer 1 plus 15%. So now here cost of goods sold. Cost of goods sold, so is equal to the sales volume is 1 lakh. Okay, the sales volume is 1 lakh. What is the cost price? 75. Okay, 1 2 3 4 5 into 75 rupees we have given, we have paid. Okay, so now press enter. So this is the cost price. So then from the year 2, okay, COGS each year increases by 20%. So that means is equal to this value into, open the bracket, 1 plus, okay, 1 plus 20%. So now close the bracket and then press enter. See now. So again you just drag it over here, automatically you will be getting the answers. So now here the gross profit again is equal to, so the sales minus cost of goods sold. So and then press enter. See now, you'll be getting as 50 lakhs. So and then again you have to drag it over here, automatically you'll be getting the answer. Okay, so selling and administration cost, so that means the 25%. So what is this actually? That is a OPEX that is considered as the operating expenses. That means the 25%. Okay, so again is equal to, so this value into 25%. Okay, so again you have to drag it over here. So EBITDA, so EBITDA, so that means you have to less this. Okay, so then in the same way you have to drag it over here. Okay, so then minus depreciation. So depreciation is 2000, automatically they have given you in the question. So you just select this is equal to 3750 minus 2000 and then press enter. Okay, so you just drag it. So then again the interest. So interest is 1500. Okay, interest is 1500. So now is equal to, so this value minus 1500. So and then press enter. So EBT. So that means earnings before tax. So again you have to drag it over here. So then the tax will be 30%. Okay, so is equal to, so this value into 30%, you have to do it. So and then press enter. uh, okay, so the number of digits, it has been displaying. So now a profit after tax or the net income is equal to, okay, so this value EBT minus tax value. So and then press enter. So this is the actual profit we got in year 1, year 2, year 3 and year 4. Understood? So all the income statement exercises are done. So you have any doubts, guys? No doubts? So shall we move on to the cash flow statement today? The next topic is about the cash flow statement. Okay. So shall we move on to that? So I'll just give you 2 minutes time. So if you want to do this, exercise, you just do it. You just write out, and if you're having any doubts, you just ask me. Okay, so done, no? You have tried. So the next thing is about the cash flow statement. Okay, so we will just discuss that. So can anybody tell me what is cash flow statement? So the cash flow statement is a financial statement. Okay, so that summarizes the movement of cash. Okay, and cash equivalents that come in and go out of a company. Okay, so cash flow statement is nothing but, so whatever the money is coming in, and that should be in the form of cash only. Okay, so you have to receive the money through cash only, and you have to pay the money through cash only. So then only you have to record the transaction in the cash flow statement, like that. Okay, so all the incomes, okay, so all the money which you receive through cash, and all the payments you pay through cash only, so that has to be recorded in this cash flow statement. Understood? So, the cash flow statement measures how well a company manages in cash position, meaning how well the company generates the cash to pay its debt obligations and fund its operating expenses. As one of the three main financial statements, the CFS cash flow statement complements the balance sheet and the income statement. In this article, so we will just show you the cash flow statement is structured and how you can use it when analyzing a company. So, what does it consisting of? So, a cash flow statement summarizes the amount of cash and cash equivalent entering and leaving the company. So, the cash flow statement highlights a company's cash management, including how well it generates the cash. So, this financial statement complements the balance sheet and the income statement. So, the main components of the cash flow statement are cash from three areas. So you're receiving the cash, or else if you are paying through the cash means operating activities. Okay, so then investing activities, so and financing activities. So the two methods of calculating cash flow are the direct method and the indirect method. Okay, so how the cash flow statement is used? So the cash flow statement paints a picture as to how a company's operations are running, where its money comes from, and how money is being spent. Okay, also known as the statement of cash flows. So the cash flow statement helps its creditors determine how much cash is available, okay, for the company to fund its operating expenses and pay down its debts. See, now structure of the cash flow statements will be divided into three methods. So that means cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Understood, guys? Any doubts in this?
No, ma'am.
Okay. So cash from operating activities are nothing but, so this particular operating activities on the cash flow statement include any sources and uses of cash from business activities. In other words, it reflects how much cash is generated from a company's products or services. Okay, so these operating activities might include receipts from sale of goods and services, interest payments, income tax payments, payments made to suppliers of goods and services used in the production, salary and wage payments to employees, rent payments, any other type of operating expenses. Okay, so in the case of trading portfolio or an investment company, receipts from the sale of loans, debt, or equity instruments are also included because it is a business activity. Okay, so then cash from investing activities. So investing activities in the sense cash from a company's investments, purchases or a sale of assets, loans made to vendors or received from the customers, or any payments related to mergers and acquisitions are included in this category. In short, changes in equipment, assets, or investments relates to cash from investing. So then cash from financing activities. So cash from financing activities includes the sources of cash from investors and banks, as well as the way cash is paid to shareholders. Okay, so this includes any dividends, payments for stock repurchases, and a repayment of debt principal that are made by the company. So there are two methods, that is nothing but direct and the indirect method of preparing the cash flow statement. So indirect cash flow method. So with the indirect method, cash flow is calculated by adjusting net income by adding or subtracting differences resulting from non-cash transactions. Non-cash items show up in the changes to a company's assets and liabilities on the balance sheet from one period to the next. Therefore, the accountant will identify any increases and decreases to asset and liability accounts that need to be added back to or removed from the net income figure in order to identify an accurate cash inflow or outflow. So I want you to write down. So just make 2 points. So there are two methods of cash flow statement. So that means direct method and the indirect method. So after that you write, so there are three divisions: cash from investing activities, operating activities. Okay, so you just write down three divisions: financing activities, written. Okay, so then just we will just discuss about the practical examples of this cash flow statement. Okay, so now here cash flow 1. Okay, so cash flow 1, the first sheet. So cash received from the customers. So what and all the things you want to do it here? So actually I'll just delete these things. Okay, so now here, uh, if we just say that if we are receiving the cash, okay, if we are receiving the cash, so then we have to put directly the amount, so that means it will be in the plus sign only. Okay, so now if we just paying the cash, so then we have to put minus. Okay, minus, so that one you have to understand. So if the money is going out from us, so then you have to put minus sign. Okay, so if the money is coming inside, okay, so then we have to put plus the amount. Okay, so cash received from the customers. Okay, cash received from the customers, so you put here as 1,46,000. so that means here it is received only. Okay, so here it is received only, so that's why plus 1,46,000 rupees. So then cash paid for expenses, so here paid no, so that's why what we have to put here?
Minus, ma'am.
So that means minus 81,000. Okay, so then cash paid to suppliers. Okay, cash paid to suppliers, so that means minus 47,500. Okay, so now the total, so the total you just put here as alt is equal to, so the cash flow from operating activities, you will be getting the answer here as 17,500. Okay, done. So then after that, cash paid to acquire additional equipment. Okay, so cash paid to acquire additional equipment, so that means minus 20,300 only. Okay, so now here cash received from the investment of owner, cash received no, so here you put as 10,000 rupees. So cash received from the bank loan, so that means 50,000. Okay, so cash paid for bank loan. Okay, so cash paid for bank loan will be, so minus 27,000. Okay, so now you will be getting the answer here as 33,000. So net change in cash flow. Okay, so net change in cash flow, so that means CFO, cash from operating activities, cash from investing activities, then cash from financing activities. So you'll be getting the answer here as 30,200. Done? Any doubts? So I'll just share you this. No doubts in this? Okay, so we will just move on to the second cash flow. Okay, so cash flow statement number 2. So you just do it by yourselves. Okay, so this is another method of doing the cash flow statement. So that means the net income for 2016 is 1,50,000. So that one you have to put here directly as 1,50,000 only. Okay. So then after that, dividend paid. Okay, so dividends paid, so that means 50 and 75. So that means here that only the difference you have to put here, minus 25. Okay, not minus, plus 25. So plus 25,000. So dividend means it will come in the financing activities. So as I told you, minus 25,000. Okay. So after that, depreciation. Okay, so depreciation is nothing. We have no changes in this. So that's why every year the same amount it has been decreasing. So that's why you put that amount in the depreciation column. So cash flow from operating activities. Net debt. Okay, so net debt will be 50 and 65. So that means the loan. So that means 15,000. Okay, so 15,000 will come here only. So that means cash flow from financing activities. Okay, so then equity, so 5,000 and 6,000, again that also in the investing activities only you will be getting. So that means that also plus 1,000 rupees. So fixed asset gross, so fixed asset is nothing but minus 2,000 because we have paid that. Okay, then accounts receivable, so 50 and 45. So receivable means plus 5,000 only. Okay, so it is in the matter of like receiving. Okay, accounts payable is, so we are paying now, so that means minus 5 minus 25,000. Okay, accounts payable. So then inventory, so 30 here, 55. So inventory is nothing but the stock, so minus 25,000 because we are paying this. Again rent paid also minus 1,500. So this one, so you just do it. I'll just share you the file. Okay, so you can go through this one. So now the grand total is 1,97,500. So the total cash available in the company. Okay, so the total cash available in the company will be 1,97,500. Any doubts here? No doubts? 1 minute. So done this. So I'll just share you this file. You just sit and practice this one. Okay, so then we will start. We'll just go to the next thing. So that is a balance sheet. Okay, So can anybody tell me what is balance sheet? One minute. So done, no, this one. So the balance sheet is done. So yeah, you were telling something.
That contains a balance of a company of assets and liabilities, ma'am.
Ah, ha, ha. Correct, correct, correct. So both the assets and liabilities will be balanced, right? So that is called as a balance sheet. So actually, so when we have to prepare this balance sheet, what date we are going to prepare this balance sheet? So on 31st March, we are going to prepare this balance sheet, right? So that means every year. So every year, that is on 31st March, we are going to prepare the balance sheet. So both the assets and liabilities we have to balance, right? So here the term balance sheet refers to the financial statement that reports the company's assets, liabilities, and shareholders' equity at a specific point in time. Balance sheets provide the basis for computing rates of return for investors and evaluating a company's capital structure. Okay. The balance sheet is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. Then balance sheets can be used with other important financial statements to conduct fundamental analysis or calculate financial ratios. Okay, so a balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity. So the balance sheet is one of the three core financial statements that are used to evaluate a business. Okay. So it provides a snapshot of company's finances, what it owns and owes as of the date of publication. Okay. So the balance sheet adheres to an equation that equates assets with the sum of liabilities and shareholders' equity. Fundamental analysts use balance sheets to calculate financial ratios. So see, how does this work actually? So both the assets and liabilities should be equal. Okay, so how it will be equal actually? So both assets will be more actually. So on the liability side we have to add the capital also. So equity, capital, shareholders capital and all we have to add. So and then we have to balance it. Okay, so this is here is this equation. So you just write down this one, take down this one. Assets is equal to liabilities plus shareholders equity. Okay, so assets is equal to so liabilities plus shareholders equity. So this formula is initiative. Okay, so that's because a company has to pay for all the things it owns. Okay, so by either borrowing money, okay, so or taking it from investors, so issuing shareholders equity. Okay, so if a company takes out a 5 year, so 4,000 loan from a bank, its assets, specifically the cash account, will increase by 4,000. So its liability, specifically the long term debt account, will increase, will also increase by 4,000. So balancing the two sides of the equation, right? So loan is like accounts payable and the asset also, so it increases, right? So that is how we have to balance the both the sides, like assets and the liability side. Understood?
Yes, ma'am.
Yes. So shall we move on to the exercises of balance sheet? Okay, so can you see the first exercise? So here one equation is there, so you can see here. So liability plus owner's capital. Okay, liability plus owner's capital is equal to assets. Okay, is equal to assets. So here so we are having the cash. Okay, so here we are having the cash. Okay, So we have to put here, 1 minute. Yes, so we have to put the accounts payable. Okay, what is the accounts payable? Can anybody just say how much is the accounts payable? 50,000. Okay, 50,000. So is equal to, so you just select this particular cell and then press enter. So now 50,000. So and then loans payable. So loans payable is nothing but 1,25,000. Okay, so is equal to loans payable, you select 1,25,000. So and then press enter. So 1,25,000. Yeah. So now here you are having, next is about the cash as assets. So that means the current asset is cash. So is equal to 35,000. So and then press enter. So 35,000. So and then accounts receivable. Accounts receivable is equal to, how much is the receivable? So here you put 40,000. So and then press enter. So then inventories. So inventories, so is equal to 35,000 as inventory, and then press enter. So 35,000 as inventory. So then other assets. So other assets is how much? 10,000. So is equal to 10,000. So and then press enter. Okay. So then land. Okay. So how much is the land? Uh,
1,25,000.
Correct. 1,25,000. So and then press enter. So now building. So building is 4 lakhs. Select the cell. So and then press enter. Okay. So now equipment is equal to, equipment is 2,50,000. So and then press enter. See now this side, in the asset side we got 8,95,000, and let us see for the liability side also. Okay, so total liability, alt is equal to enter. Okay, so now owner's equity is equal to 1,20,000. So and then press enter. Retained earnings, okay, 6 lakhs, no, is equal to 6 lakhs. So and then press enter. Total equity, okay, total equity, so you just put here as alt is equal to enter. See now we got total liability 1,75,000 plus total equity 7,20,000. You'll be getting the answer here as 8,95,000. Understood? How to prepare a balance sheet? This is just a simple balance sheet we are going to, mean we have prepared now. So then after that we are going to see some more adjustments. Okay, so regarding the liability and the assets also, so we'll just do that, and exercises will go on. Shall we move to the next one? Any doubts? Any doubts in this, guys?
No, ma'am.
Okay. Okay then. So next, if you just scroll down, so the first case, first adjustment we will just see here. So actually, so what are all the things here? The cash, accounts receivable, everything is there here itself. So you just copy this and paste it here. No, 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 no. So we can't do that actually. Wait. 35,000, 40,000. So now paste as the second one. That means the value we have to select. Okay. Other assets. So then, what is this loans payable? Loans payable. That means 1,25,000. Okay. Mm, loans payable 1,25,000. Then accounts payable. How much? 50,000. Okay. So now alt is equal to. So then equity capital. Okay. So equity capital. That means the owner's equity and the retained earnings. So 1,20,000 and 6 lakhs. Okay. So now total liabilities, again this plus. So this one. Okay. 8,95,000. So here also. Okay. So now we will just come to the adjustment. A company named ABC collects rupees 10,000 from its existing customer against the sales. Okay. Collects 10,000 from its existing customer. So collects 10,000 means, so here we have to add, right? So the bank balance will increase. Okay. Plus 10,000. Okay. 45,000. So account payable. Okay. I mean the loans payable. So that means collects rupees 10,000 from its existing customer. Okay. So what it is actually, so this is according to the 10,000. So here also we have to include plus 10,000 because we need to pay, right? So no, wait. Here sales, no, so we have sold this. Okay. So in this inventory, okay, so in this inventory, so we have to minus this. Okay. Okay. So then receivable. Okay. So in this receivable we have to add. So again it has been tallied here. Okay, so like that, so we are going to see the adjustment here. Then the second case is about company ABC purchased new equipment. Okay, so this is according to the ABC books of accounts. Company ABC books of accounts we are recording here. So purchase new equipment. Okay, so new equipment in the sense, in this inventory we have to add plus 30,000. Okay, so on credit in the sense we have to plus add this accounts payable, we have to add 30,000 again, like that. Okay, so like that we have to do the adjustments over here. Okay, so understood about this? Understood till here? Any doubts?
Can you say, ma'am?
Yes, ma. Any doubts? Pardon?
Once again, you say, ma'am.
Okay. See, in this, which one you want me to tell? So the second one or the first one?
First one, ma'am.
First one only. Okay, fine then. So here I have taken the values here. Okay, so I've taken the values. I've just copied the values here. Cash, land, inventory, building, equipment, accounts receivable, and other assets. Okay. So here ABC collects rupees 10,000 from its existing customer against the sales. So that means, so here we have to collect the we have collected the amount 10,000 from its customer against the sales. Okay, so we have to minus this 10,000. Okay, so we have to minus this 10,000. Okay, inventory, that means we have sold, we have given 10,000, and in this receivable. Okay, so not receivable, wait, in cash column we have to add, so because we have already collected, right? So plus 10,000. Okay, so collects rupees 10,000, that means we have collected the cash 10,000, so we have to adjust this. Okay, so cash I was having 35,000, I have given inventory. Okay, I have sold the product and I have received the amount, that's all, that is the meaning. That's why I have to deduct it from the inventory and add it in the cash balance, like that. Done? Understood?
Yes, ma'am.
Okay, fine then. So this exercise, so I'll just share it to you, so you have to work it out. Okay, so just go through this. Income statement I have shared you, no? Yes, I have shared you income statement. So this income statement notes, okay, so this one also I've shared you income statement exercises, so I have to share for you. Then cash flow statement. So then about the balance sheet, then about the cash flow statement. Okay, So you have to go through all these things. So first one, you have to work out regarding the income statement. Okay. So then after that, you have to download this cash flow statement exercise. So then you have to work it out. Okay. So then tomorrow I'll just try to complete this balance sheet, because the balance sheet is very much so many exercises we have in this balance sheet. So, and I'll try to complete, and then I will share you the file. So you have to practice this. Okay. Yeah.